Well, it's a great pleasure to welcome Lex Savanto from Edelman Public Relations to the stage today. We've enjoyed the opportunity to work with Edelman, as I shared earlier, in the dissection of and discussion about their annual trust barometer, a subject that we think is particularly important for us in our industry to pay attention to. But certainly Edelman's knowledge, their wisdom and study of and counsel and guidance to clients doesn't stop at trusts. And so it's with particular interest of mine, and I know members of our team, that this panel was assembled today. I think each of you should have in your hands a very colorful collage, an infographic of sorts, reflecting a recent piece of research that was conducted by Lex's team. And he's assembled a tremendous panel of individuals here to contribute to that dialogue. Lex, I look forward to your conversation.
Great. Thank you. Thank you, David. Before we get started, why don't we let the panel introduce themselves? Steve?
Hi, my name is Steve Williams. I'm a partner in the M&A group at Paul Weiss, Rifkin, Morton & Garrison.
I'm Liz Hoffman. I'm a reporter at the Wall Street Journal. I cover M&A and corporate governance.
I'm Seth Martin. I cover financial and media relations at GE.
And I'm Arthur Crozier, the chairman of Innisfree M&A Incorporated, a proxy solicitation firm that focuses on M&A transactions in particular.
So we thought we'd talk about something interesting, shifting gears from drones to the reputation of M&A, the reputation of, and profile of M&A transactions and the companies that participate in them. But before we get started, just to explain the infographic that you're looking at in front of you, this was proprietary research that went in depth and looked at the media reporting globally of 20 deals in 4 sectors: healthcare, consumer, technology, financial services. And I think it highlights the reputational exposure that M&A transactions generates, at least just looking at the media coverage. So 20 deals generated, for 20 deals, 750 publications wrote about these 20 deals, generating over 4,000 articles. And according to the standard media measurement tools, over 5 billion impressions. That's not necessarily 5 billion readers, but 5 billion instances of those names appearing in the articles, and 5 billion instances of readers reading those articles. So clearly a lot of exposure just for those 20 deals. A third of the time, the messages that the companies articulated made it into the press. But something that was interesting that we found was the message that was most likely to gain traction, consumer benefits, was used the least often. We can imagine why, but still kind of interesting. The factor that we found that was most likely to drive positive tonality in the article was the presence of a company spokesperson. You'll see that on the right side. Without a company spokesperson, the articles were positive 30% of the time. With a company spokesperson, they were positive over 70% of the time. The industry that had the greatest traction in terms of message penetration was healthcare. The industry that had the worst performance in terms of message penetration into these 4,000 articles was financial services. So there's much more research on this that we'll be publishing at a later date, but just a couple of introductory points. So the idea of this panel is to think about M&A transactions from the reputational point of view, and in particular, the pitfalls, the negative stigma, or even the positive benefits of the deals themselves and the behaviors of the companies doing the deals. We've got legal perspective, press perspective, corporate perspective, and investor perspective through the eyes of the proxy solicitor. I'm going to start off with a question that's open to the panel. What kinds of deals are particularly associated with negative attention or negative stigma? And as you're looking ahead into next year, are there certain aspects of certain deals or certain kinds of deals, certain deal-making behaviors that are likely to come with a reputational risk? Why don't we start with Liz?
I guess I would say there's a lot of deals. I mean, there's obviously a lot of big deals that are happening right now, and the ones that I think we've seen what I call the most hair around, where public perceptions don't necessarily match up with what the companies would like them to be, have tended to be big cross-border deals that have tax implications. I'm sure you guys have read a lot about inversions over the last couple of years. There's really good financial reasons to be doing these transactions, but not everyone wants to acknowledge them because there's some political or customer, or supplier, or whatever it might be, implications. So I think that's probably where we see the biggest gap between the messages that are sent out and the messages that are received and printed and talked about.
Art, what about from the investor point of view?
Well, I think, from our perspective of really looking at the investors, what we have seen as a general matter over the last couple of years is, an increasing movement into a much more shareholder-centric form of corporate governance from a board of directors-centric corporate governance model. And along the lines of that is that the shareholders are increasingly extremely protective of what they see as their prerogatives as shareholders. And so where we've seen some real issues recently are transactions where one board or management team has been able to be presented as not responsive to their shareholders because of the way that they've approached the transaction or the way they've executed on it. And one example in particular, which is on the hostile side, was at Allergan last year, where Valiant and Pershing Square made a hostile bid. The company had previously put in a proposal, bylaw amendment that permitted shareholders to call a special meeting, but put in a number of hurdles that shareholders had to jump in order to be able to do that. Now, when day was done, 39% of the outstanding shares executed these calls of the special meeting, notwithstanding the various additional hurdles that were involved. And yet, that was a cudgel that was used seriously and somewhat effectively for quite a bit of time to be able to paint the Allergan board as being not responsive to the shareholders, not committed to the shareholder value, notwithstanding that they had an extraordinary track record of shareholder value, and ultimately produced an alternative transaction that was significantly better than what was presented by Valiant.
Steve?
To Art's point, I think the view of a more shareholder-centric environment, the shareholders have become much more sophisticated consumers of information about complex transactions. Part of that is obviously the rise of activism. You have hedge funds that are devoting tremendous amount of attention to the details of transactions, to the details of disclosure. You have institutional investors who are more receptive to the activist point of view and are also asking tougher questions, digging deeper into the questions of why was this the right path, having less deference to the decisions of corporate decision makers. And so, whereas in a transaction 5-10 years ago, your biggest concern may have been a plaintiff's lawyer who was going to bring a suit, your biggest concern now is likely, who's going to write the letter to ISS, who's going to come up with an opposition proxy, who's going to show up with a white paper that's going to take a very intelligent analysis of every decision you possibly could have made wrong in 20/20 hindsight and plaster it over an SEC filing.
Yeah, and to follow up further, and this has happened and has really caused a lot of change in M&A as well as other places. Is historically they're passive investors, index funds, didn't really get involved in this, would usually just follow one of the advisory firms or just go along with the management recommendation in M&A transactions. They are now becoming, as part of the responsiveness on their part to the general movement towards much more informed shareholders. They have become much more involved in independent decision-making on M&A transactions as well, and that can have a major impact. I remember once in the Dell transaction, sitting in a conference room with one of the major index funds who told me how their view that the transaction was not right because they had done fundamental analysis of valuation analysis of Dell and concluded that 5 years out it would be worth significantly more than what Michael was offering, even adjusted, for time. And I turned down and I looked at his business card, and it was Director of Global Indexing Strategies, and was wondering how the Global Indexing Strategies group had done this fundamental valuation analysis, but at least they believed they had. And so this was a very different change from what we had seen until fairly recently.
So you guys have brought up the topic of governance, which I think we've seen increasingly in the midst of transactions and disputed transactions. How is corporate governance becoming more a part of the perception of transactions and the ability for companies to push these things through?
I'll take it. I mean, we've seen a couple of really big hostile deals over the last couple of years, and particularly ones where acquirers are trying to use their stock as a currency. And you'll see, that a very quick attack is usually centered on the corporate governance of the acquirer, which is that you're asking investors to take their stock as currency. They're going to be investors in a company, and you start poking holes in things. I think the most recent example was Mylan Perrigo, if you guys followed that at all. A couple of big drug companies, and Mylan had moved to the Netherlands as part of a tax inversion, and in the process picked up a very unique and pretty controlled governance regime. And Perrigo used that to its advantage and ended up repelling the offer. So I think when you go out there with a hostile bid, everything about your company, from performance all the way up through governance, is very much fair game.
Lex, what I'd add is we just completed the Synchrony split off today, and with that transaction, I think what we saw was you needed a year, and Synchrony basically, we started the split off a year ago, and there was a year of that company establishing itself on its own, establishing its own corporate governance, rhythm, and practices. A lot of that team came out of GE, so I think there was a good standard there. But that team needed to establish itself on its own, and there needed to be a level of comfort for investors, and so that did take some time. And then when you laid the groundwork to do a split off of another 85% or so of the company over the last few weeks, there was a good, I think, base of understanding about what the corporate governance culture was at Synchrony now that it had been established.
Steve, any additional comments on governance?
Well, I think, the attention to things like getting rid of staggered boards, getting rid of poison pills, there is an expectation of more openness in companies, and that's one of the reasons why the Mylan stitching mechanism that they used in the Netherlands was fairly shocking to people. It's an interesting feature of these inversion transactions, which have gained a lot of attention, and they have gained a lot of attention, principally from the competing interests of, on the one hand, every stockholder has an interest in lowering the tax rates and being more competitive abroad. On the other hand, there's something that just sort of grabs at people on the idea of leaving the country in order to get a more favorable tax rate. And it's really taking the attention of shareholders here in the US and making it part of a broader global conversation. So now all of a sudden, the Mylan situation was a competition between very restrictive Dutch regimes and very open Irish regimes, and causing our vocabulary to have to expand.
Got it. Who knows what new vocabulary word we'll have with the next inversion announced. Seth, you work for a company that's been going through a lot of M&A activity, a lot of divestments. Are there circumstances in which you felt the company's reputation was put at risk or in a precarious position because of how a deal unfolded? Any examples of that?
Yeah, I guess to give you an example, now on the financial side, it was interesting as you talked about kind of understanding of of deals in the survey, that's probably been, ironically, the area where there's been the most understanding for our company, because it's so tied to the stated strategy, which is to move out of financial services. And so as we do deals there, it's been very clear to investors, and I think it's, and as we look at the media coverage, it ties instantly back to a very clearly stated strategy. So that's great. On the industrial side, I think, regulatory risk and I put sort of my media hat on, the understanding of why deals, may or may not happen based on the regulatory risks that we're going through. So, we had a long road to get our deal to acquire Alstom done. We got that done earlier this year, and it's the largest acquisition we've ever done on the industrial side. A lot of what had to play out in the regulatory process there did play out in public. And every step with the EU had to be very well explained to the media and why it was happening. So, you have some things that are fairly routine from the perspective of Brussels when they're analyzing a big transaction, in terms of, extensions of the deadlines, and, the required time that they need. And that took a lot of backgrounding, quite frankly, to make sure people understood why that was happening, and that it was an obstinacy on the part of the parties that were trying to merge in that case. So I think that's a situation where understanding how the regulatory process plays out, how some of it actually plays out in public, the reporters and media need to understand that.
Got it. So folks in the audience, probably more than one of you have had the idea or the opportunity to call a reporter and try to pitch them on a deal, or try to get in front of an investor and win their support around the deal that you might be working on. So the question for Liz and for Art is, what behaviors do you see behind the scenes, people calling you or people interacting with investors, that can actually throw things off, that can taint your perception? You guys are part of the ecosystem, that can taint your perception of how a deal is proceeding or the value of it. Liz, you want to start?
Sure. I think our job at the Journal is to write things first and write them smart. And those two, I think there's a wide perception that those are in conflict. They're not, I don't think. So look, we rely on people to be honest, and sometimes that's easier said than done, especially when there's a message that's trying to get out, or when frankly sometimes deals aren't perfect. Sometimes they have problems. Sometimes the price is not very good, and I think you should all assume that we're going to do our own analysis. We're going to talk to a lot of investors that, to Art's point, are doing their own analysis, and I think being as honest as you can about sort of the warts and the upsides of all of these things is probably your best bet.
So are you suggesting people call you with less than honest information?
I'm sure that never happens.
Never happens. Look, everyone's trying to shine things up, and that's your job. It's our job to not be swayed, I guess, for the most part.
Art, on the investor side?
I mean, on the investor side, straddling the investor side and the issuer, on whichever side it's involved in, clearly the last thing, as one of the parties to the transaction, that you want is something that blindsides you, that you did not prepare for ahead of time, that can go directly to the heart of whatever, or it actually doesn't even need to go to the heart of whatever your key messages are for getting the transaction done. But anything that casts doubt on, whether it's the business rationale for the transaction, financing, or anything else that, again, is a disruption that you had not anticipated. One of the exercises that you always go through is to, try to determine exactly where the vulnerabilities are, and then have a plan to address them, either beforehand or immediately upon their happening, depending upon the nature of it. And again, what you don't want is something coming up that goes to credibility, that goes to transparency, that gives people concern, the shareholders concern, that the value that they had expected is not going to necessarily be there, or that there's, again, some revelation about the board of directors, say, that could be used to show that the board is asleep at the switch or is not fully on top of the situation, which then, again, gives rise to real credibility problems.
Lex, I would just add one thing, which is, I think, the clarity of your communications materials is really, really important, and you should think about how you aim at an audience that is not maybe in your industry and knows your industry. Because what I found is that often, the people who are commenting on your deal are not the reporters and media that regularly cover you, especially early in the morning. It's really, it can be an anchor who just does not know your company that well, and producers who work with them. You got to make sure what you have, your deal rationale is extremely, extremely clear, because those first couple hours are going to be very definitive, I think, for a lot of deals.
That's a great point.
So we have a lot of advisors in the room, I think. Direct question, can the choice of an advisor make a difference in how the deal is perceived? And to what extent do advisors play a role in forming, or can they play a role, in your experience, in forming the perceptions about a transaction? Liz, that's for you to start.
For us, advisors are important because unlike companies, unless you're someone like GE, they're repeat players, right? Companies might do a deal every 2 or 3 years, one of size every 5 or 10 years. So at least on the M&A side at the Journal, and there are obviously people that cover individual companies, we just don't deal with them that often. But advisors are there all the time, and we run into them a lot on usually a couple of different things at a time. So that's where our best relationships are, and I think that's where we rely on people to sort of steer us right and to be helpful where they can. But I think especially just to think of yourselves as repeat players when you're interacting with the press is important. It's a long game that we're all playing, I think.
Yeah, I mean, I would say from the investor side, as a general matter, for the long onlys, the fundamental investors, probably not, for similar reasons, is that they don't have the same exposure to the advisors that certain, because they don't really have to deal with them in their ordinary course. Where it can have an impact on the shareholder base, though, is on the ARBs. The ARBs are dealing with deals with the advisors, and that can factor how they view it, and that can then translate into other commentary that goes beyond the ARB community and into the media, into sell-side analyst reports, and into more general circulation.
You got to know what relationships your advisors have, and to Liz's point, I mean, there have been deals where I think we thought, well, we've got a really good relationship with this publication and this media, but if you're working with, the late great Jimmy Lee, he's got better relationships than you do, and he still does. So knowing where our advisors actually had better relationships, we should work with them. That was very clear to me at certain points.
So another topic is how deals leak. And there's a commonly held assumption that it's the financial advisors that do that. The legal advisors would never do that, right? Any views from the panel on where these leaks are coming from?
I'm not touching it anywhere near it.
I have no idea.
I'm sure none of my friends in the investment banks would ever leak.
Yeah.
All right, so a better question. What are some of the worst things that you've seen after a deal's announced? The price is out, the mechanics are communicated, the rationale is clear. Some worst case scenarios of mishaps or missteps that companies made that just sent perceptions of the deal in a totally wrong direction. Examples. Steve, any thoughts?
Well, I mean, there's the obvious example of the terrible screw-up, which doesn't happen too often. There's a terrifying case before that was before the Delaware courts recently of a mistake in a spreadsheet that resulted in a company agreeing to get underpaid by $100 million in a transaction. So that one kind of hurt. You know, when we're doing transactions and we're spending time talking to boards and we're talking to management and other advisors, and we're sitting there at 2 in the morning looking at the transaction documents, and the you know, the demons start to come and you wonder, what have I missed? And it's the what relationship between a director and somebody did we not know about? What activity was going on at the investment bank that wasn't disclosed and we didn't ask the right question? It's what are all those very talented analytical eyes looking at my deal going to discover that we didn't manage to discover in the time we had? And, you know, like I say, it doesn't happen too often, but what do you do about it? It's like everything in the work that we do, you protect yourself with process. You protect yourself with, long before you get to the announcement of a deal, thinking through how you're going to get there. What are your steps going to be? When is your board going to meet? What are you going to prepare for them? What questions are you going to ask? What's the accumulated knowledge with you and your colleagues of the stuff that can go wrong? You know, there's so much going on, again, in the Delaware cases, looking really hard at investment bank conflicts and relationships, and what's the duty of a board to really drill into their advisors and know what exposure their advisors have. And what we do as advisors, and the banks and the PR and the proxy solicitors and the lawyers, we spend a lot of time thinking about process, because you can screw up. Everybody screws up. It happens. What's not forgivable is screwing up because you didn't think things through and didn't plan. You have a process, you have a deliberate way of considering a difficult decision. You may not catch everything, and you can be forgiven sometimes for not catching everything, but you can't be forgiven for not doing what people do to try and make sure you get the best outcome you can.
Others, mishaps, war stories?
You know, not from me personally, but I would say that, you know, again, clarity of communications, so where you see in the kind of initial reporting, particularly on TV, a lack of understanding of what's in a press release. Thanks. You know, when there's misunderstanding from anchors about, you know, this press release is confusing because I don't understand what exchange ratio is being offered here. You know, that I think is a difficult situation. And then also, if there's a lack of understanding that there's going to be, even if you believe the deal is pro-competition, pro-customer, that there is going to be an antitrust issue at some point, and you need your communications to match that. So I think, you know, that really comes back to haunt in some of the deals that I've seen. Not our deals. I think we are aware of, you know, where we're going to face those issues with regulators, but just not if there is a case where you're not planning that and you really go with a lot of robust messaging, and 3 months later, you know, you're in court. That's that can be a difficult situation, and I think, you know, to your point, Stephen, there's a lot of preparation that takes place that can see that coming, and you need your communications to reflect that to some degree.
Well, and you also need your communicators to be completely on board, because I mean, one of the big disasters is that you either have somebody who is not supposed to be speaking publicly, who does go ahead and speak publicly, or what oftentimes happens is that somebody goes off message, because nuance can be very important, and that then obscures the real messages and can be very counterproductive, because now you're trying to dig out of a hole to try to, you know, get out there what the person really meant when he said what he said. And you know, the level of care that has to be given to who is going to be out there speaking publicly on behalf of the company, and that person's ability to stay on message is just vitally important, because if you go off message, and again, a lot of it is nuance, you can really be stuck in a big hole that you then have to start digging out of.
Liz, there must be an example of a company where you just shook your head and said, I can't believe they did that.
It happens. I was thinking of something Art said. Message is like, advisors spend a ton of time thinking about their message, and I'll be totally frank with you, the press doesn't care all that much. It's something that gets thrown into the pot along with like heavy doses of reality and investor sentiment and what we hear from regulators and elsewhere. And so I think it's very funny when you stay on message. We would love to get you guys off message. There's actually a deal that's happening right now that I think is pretty illustrative. There's it's a company called Towers Watson. It's a big professional services firm. It's merging with a big European brokerage firm called Willis, and the deal was announced in July. And it's set up as a merger of equals, but that's obviously a very squishy concept. And the upshot is that it was a take under. It valued Towers Watson at less than it was worth the day before, and that's a very unpopular move. And the stock very quickly went down. And we call the company, and like, there's not a very good reason. It was calculated using a 20-day volume-weighted average of this and that, and I think I have no idea whether it's a good deal or not, but they obviously think it's a value-creating merger, but the message got completely lost, and investors, there's an activist in it, to someone's point, and they're unhappy. So I think and that might have happened anyway, because investors are going to do their own analysis and decide whether the price makes any sense. But in situations like that, where there's going to be a wart on this coming out, I think it's better to just own up and try to explain why it's worth it.
So you're working on a story, Liz. You've got the company in this ear, and you've got investors in that ear, and maybe there's labor unions or some other audience. Which one are you listening to more closely?
Look, our job is to balance a lot of the information that's out there, and to, above all, print things that are accurate. Right? Is it accurate, fair, and responsible, like in that order, right? And intelligent and timely. And so we understand that there's a message that you guys want to get out, and sometimes it's right on point. Sometimes it sounds, frankly, pretty silly when you say it out loud. Investors as a group are really smart, and Art knows this well. Yes, some of them are in there to make the last nickel, but a lot of them know your company very well and are not shy about speaking out when their perception doesn't match yours.
That point about sometimes it sounds pretty silly when you say it out loud. I think one of the most important functions that we as advisors do is challenging our clients and channeling the passion they have for their own point of view against the realities they're going to face outside. I dedicate a lot of my time to getting yelled at by a client who doesn't understand why I don't see the crystal clear logic of what he has to say. And I say, all right, well, just for the fun of it, you're going to face somebody who's going to say this. And once you're confronting somebody out in the world who disagrees with you, it's still got to sound good. And so, we devote a lot of attention to challenging our own ideas, challenging, there are a lot of people out there who are devious and inventive, and they're spending time thinking how to poke holes. So we spend a lot of time being devious and inventive and figuring out how to poke holes.
Ever said about me.
Well, I was actually talking about me, but yeah, I'm sure you do too.
So,
And one other thing I'd just add on that, Lex, is, a lot of, if you're doing a deal that you believe in, I think you want to encourage the media to talk to investors. And, we absolutely do that, because sometimes you'll have a situation where they're talking to you, they might be talking to your competitors or other people. You want them to talk to that kind of impartial voice. And again, if it's a good deal and it's value creating, your investors should stick up for it. So
But you want them to talk to the right shareholder.
You talk to them first, though.
No, I wouldn't say we do, but yeah, to your point, yeah, you want to talk to big institutional investors who know what they're talking about.
And who believe in you. There you go.
So a quick survey of the panel. 4 individuals, chairman of the board, CEO, CFO, largest investor, long-term investor, not one of those phony baloney short-term investors. Which one, they all have something different to say about the merger. Which one do you trust the most? Steve, quick.
It depends who's going to have the job when it's over and who won't.
Okay, good. Liz, which one? You got to pick one.
Chairman of the board.
Sean?
I got to go with CEO.
I'll go with CFO.
CFO, okay.
Because he's got to live with the numbers and the reality afterwards.
Okay, good. You talked about individuals going off script or talking out of turn. I think one category of executive, namely the board, is sometimes guilty of what you're describing. Can the panel talk about under what circumstances does it make sense for the board to get involved in external perceptions? Probably not on the record or in a visible way, but under what circumstances does it make sense for the board to get involved in talking to the outside world about how this should be perceived? Art, do you want to start?
Well, again, it all depends on the transaction and the situation that's confronting you. But if you have serious issues with the shareholders, you really want, ideally, the chairman, or if he's not independent, a lead independent director, talking to the major shareholders. Because again, so much of this comes around to, as we were saying, process and board process and credibility. And the shareholders recently, this is a fairly recent phenomenon, but the shareholders really want to hear from the board of directors to make sure that the decision was reached through a good process and that the board is credible in what they're saying and knowledgeable, since ultimately they're the ones that approved the transaction before it went to the shareholders. That's been a situation across the board in terms of issues that involve shareholders, but the role of the board in a whole variety of different circumstances in terms of their relationships with the shareholders and outreach to the shareholders has exploded in the last few years.
Liz, have you run across that?
Yeah, look, I think the board can be really credible. The CEO is looking out for his or her job. I think the board is there to represent shareholders, but has a little bit of sort of that exposure to management, to the process, and their reputations are on the line too. When shareholder suits come, they name the directors, and if you screw up badly enough, there's personal liability there. And so I think they can be a really good conduit. They probably have a little more credibility with investors and with the press than any of the advisors.
But do you have a lot of conversations with board members in the course of your work? Because I shudder at the thought of putting a board in front of you, but I'm just curious if that's just me.
I think they could be a very valuable channel because they happen very separately. They have different interests to worry about. They have different reputations to worry about. They're not joined at the hip to the company, especially if it's a special committee situation. That's a deal that involves management or there is any sense of a conflict. I think you put your lead special committee director in front of anyone who wants to talk to them.
Okay, David, do we have time for any questions? Or?
Let's take one.
Okay, question from the audience? Gentlemen, the third table there.
Question on a merger of one company with the other, either by acquisition, where the larger firm buys out the smaller one, or merger, and they have to have a vote of a majority of the shares, not just the people voting. If there's no main argument and if there's a nice benefit to the company being bought, generally, does the company succeed generally, based on your experience? That is the company who wants to do the merger. Do they usually get enough votes, based on your experience?
It's very unusual for a transaction not to be approved by the shareholders. It certainly has happened, but it's highly unusual.
Audience, thank the panel. Thanks, everybody.